Tesla on Thursday reported third quarter deliveries that set a record for the company, with the EV maker delivering just over 497,000 cars in the quarter. Shares down about 4% in late afternoon trade on Thursday, but coming off a 30% rally in September as the stock wiped out its 2025 losses. Joining us now to discuss the outlook for Tesla is George Gianarikas, Managing Director at Canaccord Genuity. George, thanks so much for stopping by. Love to see a good Michael Scott reference at the top of your note today. I'm curious how you thought about those delivery numbers and how it really sets up the company into a year where I think you're looking for them to inflect back to growth on the vehicle side of the business.
Well, it's really important because, as I'm sure you remember, over the last 6 to 9 months, it's been pretty difficult for Tesla. They saw year-over-year declines in revenue and deliveries. And so this was a pivotal moment. They've proven to themselves, to Wall Street, that they actually can grow the company again. And it was super important to see that inflection point in deliveries. But the question now is whether that momentum can continue into Q4 into 2026, particularly as some of the EV incentives in the US rolled off a couple days ago. And we think that will happen likely because of new vehicle introductions. They've promised a couple to us, at least one, over the next few months, and we think we'll see them, and that should sustain some of the momentum that we saw in the third quarter.
Yeah, George, I'm curious the extent to which you think that incentive expiring at the end of the third quarter pulled forward demand, if that, like how much that factors into the number that we saw, and how you think about that in terms of what's the normalized level, let's say, of demand for Teslas going forward from here.
That's a great question. I mean, I think it's fair to say that it probably did. There are people sort of lining up. The inventories came down. They sold more than they produced in the quarter. So that would imply to us that there was definitely some pull forward. What we have modeled in the fourth quarter is that we'll see a sequential decline, which goes against what they normally see. More people buy cars in the fourth quarter than the third quarter. But that's okay. I mean, I think most people expect that. The real question mark is, can they grow the company? Can they grow revenues in 2026? And beyond. And we think it's, like I said, it's likely because they'll have new vehicles that introduce, probably create some excitement on Wall Street and from consumers. So we expect that to happen. What's really important as well is that if you look at what's happening in the EV marketplace, there's a lot of concern from some of the traditional OEMs around EV demand in 2026. And we get it because of those EV incentives. But to the extent those companies are pulling back on their offerings, it creates an opportunity for Tesla to sell more EVs.
Yeah, it's interesting. I can't remember exactly what quarter it was. Elon said something to that effect of like, a poorer incentive environment is actually good for Tesla, I think, for a lot of the reasons. We all know their position, marketplace, et cetera. Before I let you go, I wanted to ask you about how you think about, let's say, the balance of the Tesla story at this point. Robotics, AI, those much bigger pie-in-the-sky goals that I think Elon prefers to talk about, whether it's on the call or in other contexts. Today we had the delivery numbers, but as you guys work through the story, what you like about it, what you don't, where does that factor in? Is there how do you kind of maybe sum of the parts it at this point in the story?
It's a really, really good question. We wrote a delivery preview note, I think it was earlier this week, and we basically wrote about our struggles in keeping our buy rating because on the one hand, they have all these good things happening, like you mentioned. They have robots coming, they have the robotaxi deployments, they have new EVs, they have energy storage, which we think should continue to see momentum. On the other hand, there's the EV subsidy issue that we talked about. And there's the earnings power. Look, lots of people do different things to get to the valuation, the right valuation for Tesla. We consider ourselves sort of meat and potato analysts. We just like to look at the earnings, particularly how they relate relative to the rest of the Mag 7. And we looked out to 2028, looked at our earnings power, which is a tad below $12. We applied a pretty healthy multiple to it, given the fact that they should grow significantly beyond that year. But it's tough. You have to really look forward to justify the valuation. And for us, we try to look to 2020 earnings power to sort of justify our Tesla stock target and to think about the story. But even if you look beyond that, you start to think about robots and more robo-taxis. But that's a far way ahead. So we sort of try to ground ourselves in some sort of earnings multiple in a couple of years' time.
All right, a couple of weeks, we'll get an update on the third quarter from Tesla. George, always appreciate the time.
Thank you for having me.
Let's bring in Brian Moody, Kelley Blue Book executive editor. And Brian, I want to start with those Tesla delivery numbers. Surprising to the upside, yet shares are down just around 2%. So what's your reaction to what we heard this morning?
Well, one thing investors may be responding to is that this is a temporary bump because of that federal incentive. Remember, that's a taxpayer-funded incentive for EV purchases. At the same time, we sold plenty of Teslas before there was an incentive, and my guess is we'll sell plenty after. Same with other electric car makers. Only now, the lack of the incentive is going to have to make people want to buy those cars based on their own merit, not because they're going to get a big discount.
So let's talk about the expiration of the EV tax credits. I mean, are there companies that are more exposed to this than others? I mean, my head goes to Tesla because it's that pure play EV giant. But are there ways that maybe they can rise above that expiration?
Yes. What we've seen from Tesla in the past is when they lower prices, orders go up. And I think that is a trend for the overall industry. It's very telling that we're talking about the removing of a taxpayer-funded incentive for electric cars. And at the same time, what's happening? We're seeing record Q3 sales results. August and September, I think it's going to end up that electric vehicles overall made up about 10 to 12% of the market during that time. What that tells us is that product is priced too high. When you remove price, that's a barrier. More people want one. So what's going to have to happen for automakers going forward is they're going to have to find a way to right size the price for those vehicles, Tesla included, to get more people in the seats of those cars.
And to that point, we are seeing certain automakers respond with deeper discounts. So could there be a world that maybe we have a steady decline in these EV car prices and it doesn't even matter if we have these government subsidies or not?
Yes, that will definitely happen over time. One thing that's going to happen in the meantime, though, is you're going to see models go away. Certain automakers that said they were all in on a fully electric fleet by, say, 2025 or 2030, some of those models are going to go away. But at the same time, the prices on some of these electric cars, the good ones, will rise to the top because without this incentive, now people want it to make sense on value, features, durability, and cost effectiveness. So we'll see prices come down over time, mainly because that's what happens with technology, right? As time goes by, technology becomes more affordable. Think of something like consumer electronics, phones, and big screen TVs are perfect examples.
And from an investor standpoint, should we expect a dip in Q4 auto sales, given the fact that buyers were front running a lot of those purchases to lock in those incentives?
Yes, that's almost likely going to happen just because of simple math. You had all this demand as they rushed to beat that price incentive, and it's only natural that it's going to drop off a little bit, maybe even as much as 50%. Now, some automakers, we are hearing that Ford and GM may have found a way to give pre-down payments on cars that they know they'll sell even before they have a buyer for it by using their financing arm. So that could help boost the sales of those cars into Q4. But for the most part, you're exactly right. The sales are going to drop temporarily. I think over time, they will bounce back to their right place.
And as we see consumers maybe become a bit more choosy about the types of cars that they're purchasing for both gas-powered cars along with EVs, what's the used car market been like? And how does that compare to some of these newer vehicles on the market?
Well, one thing we know is that electric cars tend to depreciate very rapidly. So whenever you see analysis of the cost to own, factor in initial purchase price and depreciation. The good news for consumers is that if you're looking for an electric car, a used electric car will be an amazing bargain. Like, they are really competitive in terms of pricing. But at the same time, you get lots of compelling features and you get lots of cool safety equipment. So it can work out for consumers if they're looking for a good used electric car.
And finally, for shoppers looking to buy or trade in, end of year is usually that time that we see the most deals, the most tax incentives. Is that still the case this time around, or did that playbook change a bit with the expiration of these tax credits?
I think there's several things putting pressure on that. Of course, you're going to see a little bit of that. It's going to be model by model, not brand by brand. But the two things that we're seeing is the expiration of the incentives plus tariffs. All of those things could have the potential to make the 2026 cars more expensive so that you may be able to get a discount on the 2025, but that's probably it. Going forward, not every automaker can afford to absorb the tariffs as many are doing right now.
All right, Brian, a lot to think about as we head towards the end of the year. Appreciate it. Thanks so much.
Yes.